Hey everyone, welcome back to Corporate Decoder, the place where we untangle those confusing corporate filings. Today we're diving into a report from Blue Owl Capital, and trust me, it's not just about owls or the color blue. There are some interest rate changes, and you know what that means for the bottom line. This report, filed on April 9, 2025, is called an 8K. Think of it as a corporate breaking news report. Companies use it to quickly tell investors about big events. It's like a financial bat signal. So what's the big news from Blue Owl Capital? They've tweaked an agreement related to something called the Secured Credit Facility. That's a fancy term for a loan agreement that a subsidiary RACC3 Financing 2 has. Basically, they changed the terms of their borrowing. This isn't a brand new loan. It's actually the third change or amendment to an existing loan agreement dating back to December 2021. They already tweaked it in February 2024. Think of it as constantly adjusting a recipe to get it just right. Here's where it gets interesting. They changed something called the applicable margin. In simpler terms, this is the interest rate they're paying on the loan. It went down from 1.95% to 1.70% per year. That might not sound like much, but it can save them a good chunk of change over time. They also changed the make-whole fee, which applies during the revolving period. This is a fee they might have to pay if they pay off the loan early. The details on this one are a bit vague, but it's another piece of the borrowing puzzle they've adjusted. A revolving period is the duration of time during which additional funds can be withdrawn from a credit line. Here's a key point. Even though this loan is technically held by a subsidiary or CC3 Financing 2, it's considered Blue Owl Capital's debt for certain calculations. Specifically, it impacts how they comply with the rules set by the Investment Company Act of 1940, which regulates Investment Company Act of 1940, which regulates investment companies. This section is basically just confirming that the changes to the loan agreement create a financial obligation for Blue Owl. It's a formality, but it's required. And finally, we have the exhibits. Exhibit 10.1 is the actual amendment to the loan agreement. You could read through all the legal jargon if you wanted, but that's why you're watching Corporate Decoder, right? The Exhibit 104 contains cover page interactive data. Accession Now, what does all this mean for Blue Owl Capital? Well, the lower interest rate is definitely a positive. It means they'll be paying less to borrow money, which frees up cash for other investments or operations. In today's economic environment with high interest rates, any decrease in cost of debt is a plus. The amendment to the make-whole fee is harder to judge without more details. It could be a good thing if it makes it easier or cheaper to pay off the loan early, or it could be a bad thing if it makes it more expensive. Overall, this report suggests that Blue Owl Capital is actively managing its debt and trying to optimize its borrowing costs. That's a sign of a well-run company. However, it's important to remember that this is just one piece of the puzzle. To get a full picture of Blue Owl's financial health, you'd need to look at their other financial reports, such as their 10K and 10Q filings. Blue Owl appears to be making smart moves to reduce their borrowing costs, which is crucial in the current economic climate. This indicates a proactive approach to financial management, but keep an eye on their overall debt levels. While these amendments seem beneficial, always consider the broader financial landscape. Thanks for watching. If you found this decoder helpful, please like, comment and subscribe for more insights into the world of corporate filings.